Hello, and welcome to a Coalition Greenwich presentation on trends in diversity, equity, and inclusion, or DEI for short. My name is Feng, and I'm the head of research for investment management at Coalition Greenwich. The purpose of this presentation is to share some of the salient findings from a recent study of ours that focused on DEI issues. Before we start, I'd like to say a quick thank you to all those who participated in our research. As always, one of the main objectives of our studies is to provide institutional investors with views from their peers on topics of interest. In recent years, ESG has increasingly taken center stage in the public's expectations for companies and in investors' desire to deploy their assets, not only for returns, but also to do good. As a component of ESG, DEI has also been embraced by many investors, as many have come to recognize that organizations that live by DEI principles have the potential to deliver better outcomes in terms of both business growth and brand reputation. So what is the state of play in institutional investing for DEI? What aspects of DEI are most important to investors, and what challenges do they face? What role does DEI play in manager selection, and how do investors think of the performance of their managers? These are some of the questions that we set out to answer in our research. During the first half of 2022, Coalition Greenwich interviewed over 400 large institutions across North America, Europe, and Asia, who share their valuable insights on these topics. In this briefing, we will highlight several key findings from this research. As a measure of asset owners' commitment to DEI issues, we'll start with a top-down view on whether investors have dedicated internal DEI resources. As the data shows, globally, a third of all institutions have put in place a dedicated DEI department or staff. However, the level of adoption clearly varies by region. The US stands out and is by far the highest at nearly 60%. UK comes in a distant second at 31%, followed by Canada and continental Europe. In contrast, Asia is much lower at just 12%. It's interesting that this regional pattern for DEI is quite a departure from what we see in ESG adoption overall, where Europe has typically been the leader. This is likely because climate change and carbon emissions have been the top ESG issues in Europe. We have also observed some variations across institutions by type and by size. For example, in the US, DEI resources are much more prevalent among corporate pensions, endowments, and foundations than at public pensions, and are more common at larger plans than smaller ones. Next, we turn from an internal view to an external view and look at the role DEI plays in how investors select asset managers. Globally, about 30% would consider DEI either extremely or very important when evaluating their managers, which is a meaningful proportion. That said, a similar percentage of asset owners do not yet consider DEI important in manager selection. Given the somewhat nascent stage of DEI, this isn't entirely surprising. Here again, there are significant variations across investor segments. As one expects, asset owners that have internal DEI resources consistently place greater weight on DEI, and that's what the data shows. By region, DEI plays a bigger role in the US and Canada, where investors that consider DEI important clearly outweigh those that do not. However, the opposite is true in Europe, where nearly 40% do not yet pay a great deal of attention to managers' DEI credentials. Overall, though, given the considerable swath of institutions that do pay attention to DEI, asset managers that already have a DEI focus will likely have a built-in advantage over those that do not, particularly North America. Among the many aspects of DEI, gender and race ethnicity are top of mind for institutional investors. Globally, 85% shortlist gender and 78% cite race ethnicity as among their main DEI focus areas, far ahead of all other issues. Notably, Gender and race are also consistently the leading causes in all geographies. Beyond gender and race, there are several other DEI areas that attract considerable attention in specific regions. For example, LGBTQ and veteran status are frequently cited in the US, as are age and inclusion issues in the UK. So what do investors think of the DEI efforts by their asset managers? The answer in a word is mixed. While a third of all investors rate their managers either excellent or above average on DEI, relatively few, just 6%, gave them excellent marks. Perhaps unsurprisingly, institutions that place greater weight on DEI are generally more positive about their managers' DEI performance. This is likely because these investors have already started to surround themselves with managers that, in their view, clear the bar on DEI. Now, if we zoom out and take a look at the asset management industry as a whole, the DEI picture that emerges is even more mixed and, in some ways, a bit concerning. Globally, 30% of the investors actually have a negative view on the asset management industry's DEI record, outweighing the 20% that hold a positive view. And investor feedback looks to be more scathing in Europe, where there are far more negative ratings than positive ones. Now, as we saw earlier, European investors don't yet place a great deal of weight on DEI as their counterparts in North America do. But the findings on this page should nonetheless raise a flag for asset managers operating in Europe, as they will not want to fall behind their clients on the DEI issue. Given the steps that many managers have actually already taken to diversify their workforces and address other social issues, it's also likely that some managers simply are not doing enough to communicate their commitment to DEI. This communication challenge could also be related to a measurement challenge for DEI, as our next data point will show. When asked about the main hurdles for advancing DEI, a majority of institutional investors highlight challenges in the measurement of progress and perhaps related inconsistencies in definition. These two barriers to DEI adoption are common across all regions. This finding underscores several underlying challenges that are unique to DEI. First, unlike the E or the G in ESG, social issues are sometimes less tangible and have a less established track record of data. Also, company DEI programs are often managed by HR. Some metrics are tracked, some are not, or may be housed in different systems. And all these contribute to the struggle that many organizations would face in tracking and reporting their progress. By the way, these challenges are not unique to DEI. One of the main frustrations that investors have with ESG overall is the lack of consistent and reliable metrics. This has given rise to numerous efforts to standardize definitions and metrics, which remain a work in progress. Looking forward, one piece of good news from this page is that in terms of the future of DEI, most investors do not view implementation cost or investment returns as barriers to DEI adoption. It's been a pleasure to review our latest findings on DEI in institutional investing with you today. We look forward to sharing more insights on this and other topics in future briefings as part of our ongoing exchange with institutional investors. Thank you.